And we are live. Welcome to the Profit Zone, where we discuss building wealth one property at a time. I'm Don Walker. I'm here alongside with my co-host, Jay Karp. And today, guys, we have an amazing topic. We're going to be talking about insurance as well as risk management, which is definitely a need in the real estate industry. And it's a hot topic today, right? So I think the best part about our conversation today is we have somebody that has over 12 years of experience when it comes to structuring and analyzing policies and programs, not only for national real estate operating owners, but also regional operating owners, right? Some of his clientele consists of people who invest in, shopping malls, apartment buildings, self-storage, office space, industrial, right? So we have somebody here with 12 years of experience supporting these real estate operating owners from an insurance and risk management standpoint. So without further ado, we want to welcome the Senior Vice President of Principal at Epic Brokers, Jonathon Wheat.
I appreciate it, Dom. I appreciate you having me on.
How you feeling today?
Very, very excited for this conversation. Blessed to be here with you, brothers, and just looking forward to a spirited and insightful conversation.
Absolutely, absolutely. We appreciate you coming all the way up from Newport Beach, right? We're in Hollywood, man. How long was that drive?
It was a little bit time. Morning is no traffic, so you get used to the flow. You throw on a podcast, and you're good.
Nice. So yeah, man. Let's jump right into it because, as a real estate investor myself, this is a necessity. Insurance and risk management is a necessity when it comes to managing this asset. So with your experience, why insurance? How did you get into the insurance space? And just tell us a little bit about your background coming up and how you landed at, Senior Vice President of Principal.
Yeah, man, I certainly appreciate the question. It's even nice for folks to inquire now, because there was a time when it didn't really matter. But I started out. My dad did some investing, so we had a few properties in Oakland, California, and he would kind of manage those as I was growing up. So it was certainly something I kind of watched him do. And then when I got to college, I originally wanted to be in investment banking. Went to St. Mary's College. Realized that path might be a little too strenuous for me. Got an opportunity as an insurance underwriter. It's very similar to mortgage underwriting. And, didn't really look back. Worked at AIG, worked at Chubb for, 5 years kind of a piece, and then did a total of 10 years on the underwriting side. I really learned kind of the nuts and bolts of what is insurance? Why do people use it? How does a consumer, how does an investor experience insurance? And then 3.5 years ago, decided to join the brokerage side and get on the sales end, and now blessed enough to lead a team and have a pretty large and consistent clientele list that we can kind of help, and we structure their insurance. We provide consultation, advisory for contracts, new acquisitions, and could not be happier.
That's awesome, man. That's awesome. Huge. When you think about your career path, what inspired you to I guess get into management and leading a team? How did you have that I would say this belief in yourself to make that step?
Yeah, that's a good question. I think that's a lot of my personal journey, and I think a lot of my friends' journey and the people I really appreciate is really about redemption. It really, wasn't I didn't start out on third base or second base or barely first base. And even if you looked at kind of my high school trajectory or middle school, I certainly wouldn't be the person that stood out of line to take a leadership role or wanted the accountability or wanted the kind of pressure that leadership required. But certainly as I got older, I realized that, I did have the basis for the leadership qualities. It was just about stepping out and kind of taking that risk and being okay, being an individual and being the one that people are going to look to when something goes right and when something goes wrong. Mm-hmm. And so at some point in my career, I realized that folks that are really building generational wealth were looking and feeling different. because people that are doing the same thing, they get the same returns. And it's true from an investment standpoint, from a life standpoint. And so, I realized that I accrued a team that I can kind of mentor and get them thinking a similar mindset as me, and then we can all kind of grow together.
That's huge.
That's awesome. So as you transition into the VP role, what are some of the key characteristics that you had to embody to make that switch into that atmosphere?
Yeah, I think what's interesting is that when you're a solo individual and you're doing something, you're your own kind of production person, or whatever your work day to day, you sit at a desk and then you report out, right? But when you have people that are relying on you to get stuff done and are looking up to you, it's not just about how you do it's not just about the work you do, but it's about how you do your work, right, and then how you communicate that to the stakeholders around you. And then, because that allows you to kind of carry a certain amount of influence and a positive influence, right? To motivate people, to mentor people, to get people excited to come to work every day, because that same level of enthusiasm that you have with your investments and your real estate, you want the people around you to carry that same level of investment. And I think that that was one of the quick things I noticed is that I had personal models and mentors that I had worked with, and I needed to be able to communicate that to the team around me so that they were able to kind of build some of these same skill sets and habits.
Nice. That's awesome, man. That's awesome. That's awesome.
Perfect. Let's talk about the state of the commercial real estate insurance market right now. It's a hot topic. I got some frustrations myself.
A lot of frustrations out there.
You know what I'm saying?
You're not the only one.
But before we jump into that, let's just talk quickly about hey, what's going on and what's driving these aggravations in the commercial real estate market, specifically on the insurance risk management side.
Yeah, I mean, I think the the real estate market is unique, right? Because you've got it's demand focused, right? You've got supply, you've got demand. But then you also have interest rates, right, and availability of cash, which influences that, and macroeconomic factors. Insurance is a little bit less. Like I talk to my friends from real estate, and they're used to that confluence of factors. While insurance is really very much a supply side item, right? Because it's about how much capital is going to be deployed to provide limits and coverage for individuals. So it don't matter how many people want to buy policies, because those people are going to have to buy policies regardless, because generally it's required by some kind of loan or some kind of debt covenant, right? So they have to buy it. While this is entirely supply side. So when you see the insurance pressures that you're facing, it's 100% it's going to be based around the results that insurance carriers are getting. And so, historically in the last 2-3 years, we looked at, catastrophic type of events like wildfires, floods, like we're seeing right now down in Florida with Milton, and it's really bad, and the stuff that kind of North Carolina had faced with the 2 dams. You just look at all of that, and you consider that out there's an insurance policy for every business, every house, and that insurance policy is going to be paid out. And even though these are, for the most part, they're mutual insurance companies, which are owned by individual investors or people that put their money in it. So that's just like that could be a one-on-one community type of insurance company, and then you have large shareholder public insurance companies. But even those have shareholders, right? And there's pension. There's individual people who are investing in those.
Right.
So they have requirements around their returns. And when they don't start to hit certain metrics, because they're paying out, in excessive amounts in catastrophic claims, or when it comes to like frequency-based claims with individuals, like if you look in the state of California, I don't know if anyone has tried to hire or fire someone recently, but there's a lot of allegations of either discrimination, wrongful termination, and all those kind of accruals of lawsuits, right? The smaller stuff, and you have autos, auto parts that are much more expensive now. I don't know if you try to get your Tesla fixed, but it's going to cost you $5,000 if someone bumps into you, right? So you have the frequency-based stuff, you have the large kind of like catastrophe-based issues, and then kind of in between there, you have the reinsurance companies that are all looking at these insurance carriers and saying, all right, well, we have agreements with you, and they're called treaties. And year over year, reinsurance companies are able to kind of renew those treaties, and they could take more risk. They could pull back risk, it's always kind of up for grabs. And so based on how the insurance carriers perform, the reinsurance carriers then kind of respond in kind. And so when they pull out their dollars, insurance companies have to take on more risk. So not only are they having worse results, but they're taking on more of that risk, which inherently means that they're going to pass that cost on to individual consumers.
Right, the owner-operator.
Owner-operators, which is just the mom-and-pop investor, right, or homeowner.
Yeah. That's tough, man. As a multifamily real estate investor, if you're new getting into multifamily, if you're new getting into apartment buildings, you're probably just pretty much going into the insurance realm and kind of just trying to get the cheapest product to make sure that you're covered, right? So 9 times out of 10, you're not really kind of just knowledgeable about the different types of policies, right? So you may go with the cheapest option, and that might only get you a actual cash value coverage policy, right? So let's talk about how important is it to have a replacement cost, policy that covers, the cost to rebuild everything in the event that, you have a hurricane, you have a fire, versus an actual cash value policy that, hey, may cost you less per month, but if something happens, do you have the funds to now build out to what you actually purchased, right? So how important is it to have replacement cost coverage versus actual cash value?
And you bring up incredible points, and you're obviously astute as an investor. You face some of these issues before, where first-time investors really just are walking into looking to the cheapest price. And look, they have NOIs that they want to hit. They're concerned about their cash flows or investors, so I get it. But there's certainly issues out there, particularly around replacement costs, which, in general, historically, what's been called kind of like, let's call it the replacement cost. You would get that based on what it would cost to actually, bring in new materials and then, fix up that asset to where it was, right? But, we're facing this kind of, with the catastrophe claims, and you have carriers trying to look to figure out how to save money and make themselves more profitable. They're looking at the quality of asset and the risk, and they're going to say, all right, well, if this is an older asset, it's in an area that we believe potentially could face more hailstorms or wind or flood, right? They're going to look at it and say, well, we don't want to have to pay, this increased cost to replace this building if we don't believe its current status would require that many dollars if they sold it today, right? Just based on the building itself. Which, from an insurance company standpoint, you understand kind of, it's understandable for them to take that stance. However, when you do opt for something like actual cash value, you're really gonna get only the cost of that asset minus the depreciable costs coming along with how long the asset has been in place. When's the last time you redid the roof?
Yes.
What does the plumbing look like? Do you have to redo the electrical panels, right? You're kind of looking at all these factors, and they'll minus that from the replacement value of your asset, and only give you that. And that's not going to cover the cost of rebuilding your asset, especially if you look at like the what's called the total insurable value. Now, and that's just the cost per square foot to really build back to where you were before. Those costs are increasingly going up, right? Because you got labor, you got the cost of material. So you have materials, right? So nothing's cheap. You got the going out and getting an architect and the attorney, all that stuff is going up. Yet the cost per square foot that has historically been prescribed to the total insurable value, still sits probably anywhere from $175 to like $275.
Got it.
Which, if you look in California, at a multifamily in an urban environment, you're probably looking at something closer to $400 to $500 per square foot, right? So those dollars don't match even if you do replacement costs. And that's something that, I know California is putting in some ordinance to kind of work on that, but it's as much consumer driven as it is supply driven, the reason why that is.
Got it. Man, I think those are some huge points. Just in my experience, based on this topic that we're talking about now, having an actual cash value policy sucks. And I had a specific property that I did have a disaster, right? I had a fire, and I had an actual cash value policy. You know, the property was cash flowing amazing every month, right? But you never know when something's going to happen. So when you honed in on depreciation, right, the depreciable amount that was deducted off of this claim was like 30% of the payout, right? So let's just say it was $100,000 payout. So now you only are left with $70,000 to rebuild, right? You know that, hey, the price of labor and materials have increased.
Yes.
So you are basically down $30,000 to rebuild back to what this apartment building was. So if you think about $30,000, that could be 1 or 2 units that you no longer have the money to rebuild or refix. So those units will remain vacant, and this is how that could affect your cash flow moving forward, because now you have post-fire or post-hazard, you have 2 units that are completely, inhabitable. So that's the difference, and that's why it's so important to have replacement costs versus your actual cash value, right? So,
and that doesn't take into account the fact that when you do go through some kind of large catastrophic event, if this is something that's like, regional based or based on your geography and other folks are going against it too, you're also going to then have contractors coming in that are going to push the price up 2x of labor of what they normally would because they know they can do that. And I'm going through a claim right now with a client that's, it was a flood incident. And, but obviously other adjacent properties were impacted. And the contracting costs are out of control. And so much so that, they're not going to be able to use the dollars to pay off what it would cost a contractor because it just doesn't make sense right now.
So let me ask you this: with the claims, we are, like you mentioned before, a lot of contractors are in the habit of having premium contracting fees. So how do y'all vet that? How's that vetted?
Yeah, that's a good question. And it's hard on an individual level. It's really hard to be able to. It's hard because the insurance companies don't necessarily provide the contractor to do the work, unless when you reach a certain level with a certain status of carrier and you're paying a certain premium. Mm-hmm. What we do is establish preferential treatments from certain contracting systems across the country in that geography, so that if you do have something, in the case of Florida, we have clients where we have set rates with certain restoration clients that we know if they got a water incident, they're going to be there. They're going to respond within 30 days, 20 days, and they're going to have this fixed up, right? And they're going to get preference. And so that's how the large players, that's what they're doing. I mean, it's very hard on a single asset level to be able to do something like that. Mm-hmm. But it's also kind of not. I mean, I have heard of incidents of clients who go out and, they have another asset owner next to them, and they got a group in the community, and what they do is get together with a few contractors and say, hey, we know this is an issue, this could come up, we're willing to establish set prices with you and give you the contract if you can do the work in a certain amount of time. And if you're going to face a flood or a hurricane event like that might be the difference between you staying in business and you not being in business for another year or 2 years.
Yeah, that's huge. I also think, like, it's very interesting in the insurance industry how you guys really legally don't have to negotiate with contractors. So you make the owner-operator hire a public adjuster to negotiate this claim, right? And now that public adjuster gets a certain percentage of the entire claim as well, right? So it's like at every level, there is a cost for the owner-operator. Do you think it's a benefit going the public adjuster route and having them kind of fight for each line item of what you are owed, or just getting a contractor and kind of just figuring the whole claim out that way?
I think it's probably better to, if you're in the situation where you have a public adjuster, I think it's probably better just to negotiate it out yourself. In most cases, under our policies, we're dealing directly with an adjuster that's assigned, from the carrier. But obviously, a lot of excess and surplus carriers, which write in more hazardous environments, they are going to go to a public adjuster model. But at the same time, if you're working with someone like our team, we have dedicated risk control consultants and claims consultants who are kind of in the, they're the intermediaries to make sure that what's happening on the adjuster side versus the clients, that those costs are being catched by the adjuster, right? And you have someone in the middle that's kind of negotiating that. Because, at very complex claims, especially if you got multi-factor confluence of issues like water, and then you have, you can't get back into your site because it's a flood. So you have what's called a civil authority, right? They tell you got to evacuate. So you got all these issues, and they can get rather complex. So you do need someone on your side who can kind of, pitch and create the story to make sure that you get paid an adequate amount.
Got it. Awesome. Another pain point for me in this industry, we've already talked about coverage, right? Actual cash value versus replacement costs. But another thing that I'm dealing with as an owner-operator, as I continue to scale my business and acquire more assets, right? I'm not seeing the same premiums. So, underwriting this deal and doing the numbers, is taking a little bit more time, because what I'm seeing is premiums double and in some cases even triple. And, worst come to worst, some insurance companies aren't even covering multifamilies in a specific neighborhood anymore, right? So what is going on with pretty much insurance companies doubling or nearly even tripling these premiums? Because now I'm finding that I have to go through a specific insurance broker rather than your large, American Family, State Farm, your large powerhouses, right? So let's speak to what's going on with acquiring new properties and new premiums.
Yeah, you bring it up. So there's a lot there. But to go back to your State Farm versus the Farmers and using an independent broker like myself, I do think that historically, if you owned 2 to 10 to 20 to 50 to even 100 units, you could go to State Farm or Farmers, and Farmers mostly in California, but they're really good about getting you a policy, right? But unfortunately, in states like California, Florida, New York, we do have environments that are regulated by the state insurance commissions, and so this is they're obviously focused on helping consumers, but part of that is kind of regulating the insurance market, right? And just like we folks who work in any kind of economic environment realize that sometimes when you try to add rent controls, you try to play with the economics from a regulation standpoint, it doesn't always you don't get the you don't necessarily get the result that you were hoping, and so I think part of what the insurance commission has done is tried to protect consumers so much that they haven't allowed insurance carriers, particularly in multifamily, where they are facing losses and people do sue because of slip and falls and all type of issues. And we've created an environment in California that's probably too litigious and too easy for plaintiffs to get ahead, and too many plaintiff attorneys to make money. And so they just can't simply raise their rates because the environment requires that based on their results. And so when they don't get the rates that they need, and it takes a long time to get to approval, they just say, hey, we can't make money here. This is why. And then they'll leave the state. And as a private company, it's certainly under their prerogative to do that. So that kind of takes the State Farm and Farmers players out, and they're going to have the lowest rates. Right. So then you're left with, you're going to have to use an independent broker that now is going to have access to 20, 30, all these different other insurance carriers. And typically that would just be for larger stuff, right? But now the smaller guys are facing this environment as well. And so that's what I attribute that to. But then you also have kind of the social factors that are causing a lot of that, like the plaintiff's attorneys who are going in there and saying that there's a little bit of mold here, there's a little water there, and we believe there's a habitability issue, right? And so you get 10 folks together, 20, each one of them claiming that there's a reason why their space is not habitable. And then just to settle a claim like that, it's probably going to be anywhere from $10,000 to $15,000 per claimant, right? And I have clients in Los Angeles who have multiple of these. In Oakland, these are two popular venues where they have 2 in 3 years with 20 claimants. I mean, these are severely large claims, and no one wants to pay those out, and the attorneys are getting paid. And then you just have assets that are getting older, right? So, if you're sitting on something in California, Chicago, New York, and it's renting well, and you're a private owner, like why are you you're not necessarily incentivized, under our tax structure to make the roof better or necessarily fix the electrical panels or fix the stairs that are cracking, right? So you have owners that just buy these assets, and this is not all owners, but there's certainly them out there who, I wouldn't call them slumlords, but they just don't actually improve the asset for the quality of life for the people who live there. And slowly they deteriorate. And then all of a sudden they try to get insurance and the building hasn't been touched for the last 40 years, or they sell it to someone and the pro forma insurance is the same price as it was in the previous owner.
Right.
And that's not a reality.
But, and I got to play devil's advocate right here, because on my side of the business, obviously when I'm talking to insurance, they want to see pictures of circuit breakers, the mechanics, the boiler, the water, like all of the mechanics in the building, right? Now, if I'm acquiring this property, or I just acquired it for, the last couple of years, I just bought this property. If I'm already getting the max market rents as is condition, right? What incentive do I have to go in and remodel and update this building, right? Which is going to cost me money. And based on the market rents, I'm going to get the same rent per door, newly renovated or not, right? So it's a tough conversation because, yes, this is a people business and we want to make sure we're creating a sustainable lifestyle for individuals. But at the same time, this is a business and we lead profit first, right? So how do you even make an explanation of $10K per door and updating, an apartment building or whatever property when you're going to get the same dollar amount in market rents? And I think, that's the struggle with owner operators. We don't want to invest more capital into a property that we cannot get back.
Right.
And it has to make sense.
It got to make sense if we're going to put that extra, let's say you want to add a bedroom or something, it just got to make sense.
Yeah.
And what do you, as someone who has investment properties, but also works in insurance, and also understands the market, I see exactly what you're saying. And I'm often in the states where I really sympathize. I'm going to carriers and I get certain feedback, but I get it so often now that I'm a little desensitized. But, I have the same kind of reaction. And, understanding the real estate market and the insurance market, the only two options that I really see is that there's some kind of response from legislature that allows companies and owner operators to recognize those improvements, with major probably tax incentives to do it right. So I think you have possibly something there, and then there is going to be there's going to be a readjustment in the real estate market, and this is already beginning to happen where every asset that's pretty much any of my GP or LP clients are investing in or consider investing in, they heavily send me the OM before so that it can be pre-underwritten. So I can let them know exactly what it's going to cost for them to redo these old Zisco or Federal breakers, or, what's going to cost to redo the roof and how that's going to, impact the insurance. Because ultimately, it's going to be a market correction where just people are going to say what you believe the pro forma, expenses to be and the NOI to be, that's not a reality, right?
Yeah.
And maybe that gives an advantage to the large institutional guys who come in who have more, they have more scale, right? So they can get cheaper insurance products out there.
Yep.
Yeah.
So I'm sure it gives an advantage to the mega players, but I do think there's just going to be a readjustment in, how many, units are out there and then what those prices are going to have to go for based on what the insurance costs are going to be.
Absolutely. And I think just as that adjustment is coming up, as interest rates come down, we also have, property owners who have been in the game, 15, 20, 25 years, right? And some of these, apartment buildings or some of these properties have, the terms where, the arm is coming up pretty soon. and they're gonna need to either refinance out of maybe a 3 or 4% interest rate and go into a now 6 or 7 with premiums doubling, right? So it's not much incentive for somebody who has owned a property for 20 plus years, right, to obviously have less cash flow and assume insurance costs that is going up. So I think it's going to be a huge opportunity for the folks in the audience to really, really, start studying these markets and figuring out where you want to invest. And it's going to be an opportunity with more and more multifamily, single-family properties coming onto the market as interest rates come down. So a very exciting time, not only in multifamily real estate, but also in single-family as well.
And the lower interest rates mean people don't have more buying power now.
Exactly.
So it kind of works out for everybody. People could sell the home for a little bit more than or the building for a little bit more than what it's worth. And then also it's like, okay, low interest rates mean I can afford more house. Like even I just noticed how in Atlanta, just residential properties, it's like the average mortgage for these homes is like $4 or $5 grand now.
That's high.
Yeah.
Because the interest rates right now, and that's nothing crazy. You know what I mean? So
right.
It's just. But I'm definitely looking forward to those interest rates dropping.
Absolutely, absolutely. And when you talk about specifically here in Los Angeles, everybody's waiting for this. There's people, if you think about it, there's people on the sidelines that are trying to get into the market from a single family perspective, but you also got to think about there's people who actually got into the market within the last 5 to 10 years who don't like their house. This was a starter home,
right? And
they don't like it.
Yeah.
And everybody kind of talks about the real estate market in Los Angeles, correcting and having this big crash, but you got to think about there's this rubber band of, people that, don't like their living space. Mm-hmm. They got a 3% and they can't even move. Right. But when things come down and those people get kind of just motivated, now rates are 5%, 4.5%. That's going to, cause a lot of different movement in the market, and it could be a lot of room for upswing as well.
I like the upzoning too. I think that's something I'm particularly excited about in like Los Angeles markets is the opportunity to look at putting in an ADU to split it off and create another lot. I think cities like San Diego, Los Angeles, who have urban-centric environments, Long Beach, I think there's some opportunities to be very, very creative. And, we're certainly thinking about doing that at 2 of my properties. And
nice.
We'd love to.
That's fire.
Yeah, we'd love to put some in the back and maybe even separate it and, live in one and do the other. But I just think there's so many of those things coming up in LA markets.
I've seen a lot of that on Instagram as well. People talking about putting ADUs behind their principal residence. Can you go in a little bit more detail about it?
Yeah, I don't entirely understand yet. I just know that based on 2 of what my friends have done in my neighborhood in Hyde Park, that, we certainly have it. It's zoned for R2 already. So, technically we already put something separately on there. Mm. But I do believe that now we could subdivide it if we wanted to, and then potentially look at upzoning where the ADU would go. And the ADU, I've gone to a few tours right now and looked at kind of some of the modular stuff that's being done, and the prices are pretty steady. Mm-hmm. Like once you're locked in the contract, you can get certain grants within California to get some of the infrastructure work done, such as the grading and the plumbing and electrical. And then you just got to worry about that, $200 to, depending on what you want to do, $400,000 kind of dollars to build that, that built out ADU. Mm-hmm. And there is a little bit of a backlog, is my understanding, in getting them done. But I still think that, even if you lock in a year and a half and you can put it up and you can get $2,000 to $3,000 in rent in Los Angeles.
Yeah.
I'm not mad at it.
Yeah.
Absolutely not.
And not to mention, it raised the whole value of the property, of that whole plot of land. It's just gone up in value.
Yeah. Anytime that you can add square footage in Los Angeles is the way to go. With these ADUs, you got to think about it. When you're investing Chicago, Ohio, Georgia, you might have to spend, $600,000-$700,000 on an apartment building to get, $3 to $4 grand cash net net cash flow a month, right? So although, apartment building's great, you're going to get appreciation in California, right? So you look at like the dollar cost to entry, right? So $200,000 or $300,000 can get you $3,500 a month from an ADU in the Los Angeles area. So it's a huge opportunity.
I got a question for you, Dom. I mean, I know this is something I think about pretty often, but how do you think about that jump in equity in a place like California, where maybe you're not cash flowing, to the same level that you might in Ohio or Atlanta or one of these submarkets? How do you think about, all right, there's a $3,000 you can net, but then there's kind of a tax incentive as well if you're a W-2 employee and that's not your full-time job versus that equity? Like when you work with some of the folks who are investing, how do you kind of walk them through that math?
Yeah, I think that's a great question because it all trickles down to what are your goals? Is it appreciation? Is it cash flow? What's the main goal for this property? You take it one by one. But to answer your question, in my portfolio, I really like to have a diverse group of assets, right? You don't want too much of premium, right? You don't want too much of, properties that don't cash flow, but high appreciation. You want, assets in different classes, in different segments. You want multifamily, you want a little bit of, premium, you want a little bit of affordable housing. So, when the market kind of hits kind of just like a turn, typically, there's one of those assets that are keeping you alive. There's one of those segments that are keeping everything alive, right? So I think it's all about having a diverse, portfolio. And, I kind of just approach it like that.
That's interesting. My dad was heavy in the single family in Oakland.
Yeah.
And, I had 10 units at one time. And, when large rate adjustments came in the late 90s, he was hit pretty hard. And now your comment about the diversification really speaks really true to that.
Yeah. Because it's just like, hey, if your affordable housing gets hit pretty hard with interest rates, well, at least you got some premium stuff over here that is crazy appreciating, right? So now you have an opportunity to, hey, take out a HELOC and, go do X, Y, and Z or, whatever makes sense with those funds. But, if you're just very, very bullish with, one segment, there's going to come a time where, hey, it's not going to be
Right.
a nice couple of months for you or a nice year for you.
Exactly.
Just because you're not diverse enough within the portfolio.
Exactly.
Yep. So, and then I jump right back to you. We talk about insurance, we talk about your experience, but obviously this is the real estate investing podcast. So, your first property, how did you get started, and what were your goals?
Yeah, I mean, the first property really was just a single family home.
Nice.
I mean, that was the idea was to get myself into a home and figure out, all right, well, how do I maintain a home? What's important to me being in particular neighborhoods? Like, what am I looking for, right? And I think throughout the process, I was able to kind of narrow down, and this is before I understood what a pro forma was. I really understood NOI, ROI, or cap rates, or right, any of these kind of metrics, I didn't really understand. So a lot of that was just getting in and figuring out, all right, this is a community where I feel like there's a lot of upside, right? And I think now I'm in a different position where I'm really more looking at the W-2 tax implications. And so that's why the idea of looking at maybe passive investing in some kind of GP fund to get started on like kind of the larger scale.
Yep.
Or then looking at the Cleveland, Ohio's, Minnesota. And right now I'm kind of in the process of working on a few different underwriting models to really figure out, all right, based on different lender requirements, what are kind of the real, based on the DCRs mostly, like, what kind of debt coverage ratios, based on the money I want to put down, whether it be Fannie Mae or FHA or something like that, like what are the real requirements and what's really going to work?
Yep.
I think those are the kind of the plays that I'm really looking at right now because the equity is great in California, but I need something to offset the taxes.
Exactly. Yeah. And I think that's a huge point when you talk about debt coverage ratio. Oh my God, I'm an investor that focuses on multifamily properties that are somewhat turnkey but under rented, right? So if I know the rents are, currently $800 a door, and there are, tenants that have been in those properties for, 15, 20 years, and I know that the market is $1,250, right, per door, and they're at $800, that's my ideal property because I know there's, pretty much the homework is turning over those tenants. Now, where I run into issues is getting those deals approved with my lender, because when you talk about debt coverage ratio, now you're buying this property at, market rents, right? But the true rents are $800 a door. So you got to kind of find that sweet spot, because if the seller is selling this property at market rents at that number, when you go back to the bank, it's not going to meet the debt coverage ratio. And that ratio, whether it's a 1.25, 1. Whatever they require, is really important for that lender, just from an overall, risk standpoint. So
let alone whether you're doing like I was looking at the Fannie Mae this morning, right? And you live in, they give an option to live in one, and then you can purchase up to 4, I think, is in California. And but you can't include that income from the unit that you're living in towards the debt coverage ratio as income. So you got to minus that out.
Yep.
So like that even then skews the numbers, and it's going to make your debt coverage ratio way below that 1, and they're still looking at a 1.25 requirement even on institutional kind of like Fannie Mae, Freddie Mac, that's supposed to help out smaller investors.
Nice, yeah. All great stuff here. All great stuff. Where do you see yourself in the next 5 years, specifically within your insurance realm?
Yeah, I mean, I think I certainly have entrepreneurial inclinations, and I don't really 100% understand how that's going to play out.
Got it.
But I do think in the next 5 years, especially with the growth, my particular team has been having, I really appreciate the company I'm at. I really appreciate the leadership and the support, and I think in terms of I'd really just like to take our being $1 million, $2 million, $3 million producer, from to that 5 to 10 million type of business. And at that point, you're like a independent broker in real estate, except it's reoccurring, right? So as you kind of build, you get the benefit of everything you built. And so, I'd really love to push that number up to 5 to 10 million. You kind of build out the team so that I have more brokers out there that can be working with the carriers, but also more folks out in the market, kind of talking about the implications of insurance and real estate and how those worlds mesh, and helping out more people. And then kind of leading that team and then growing. And outside of that, just, growing my family, investing in real estate to try to, offset some of these taxes and build with brothers like yourself,
I think that's huge, man. The insurance industry is not talked about, much. It's not this sexy topic, right? And I think what you're doing in the industry is great. And I know the book of business is booming. I know it.
Business is good. Business is certainly good, and I was very blessed though to have some really good mentors. Even before I got in, my good friend, I give a shout out to Ivory Robinson at Newfront, who's a great mentor and friend of mine, and she is the insurance broker for Black Lives Matter.
Nice.
Real grassroots lady from Los Angeles, now living in the Bay Area. I believe she's also the only sister who's the insurance broker for a publicly traded firm. And,
nice.
She was my mentor coming in. So I think with mentors like that, it was only a matter of time that I was going to be successful. But, things are good. But most of that is from new client acquisitions. We really like to come in and try to help our clients offset those insurance costs. So, there's a lot of folks out there who just were already doing pretty well. And then they've got a lot of attritional, movement just from the rates going up, right? The rates go up and they get paid. A lot of our deals are so large, they're on fee deals. Or, we have kind of contingent deals, or there's a lot of different structures that we work in so that we're not just, our clients pay more and we get paid more.
Nice.
That's a good model.
Awesome. So we do something pretty transparent on this show.
Yeah.
And sorry to put you on the spot here, but we talk about a transparent moment, right? A transparent deal. This could be a deal that you scored a big win, one of your best real estate deals or one of your best insurance clients, or this could be a challenge or a huge loss, right? Your largest loss on a real estate property, right? Your largest loss dealing with a contractor. Specifically, I share all the time, and me and Justin, I talk about, obviously issues that we've had with contractors, but I had an apartment fire, right? Huge, huge nightmare. Justin, he's had, his wins and losses as well,
Sure.
In this game, it's not all flowers.
Right.
It's very, 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 beneficial at times, but there's your losses as well.
Absolutely.
So, if you will, share with us, it doesn't have to be a win, doesn't have to be a loss. You can pick. What's one of your biggest wins or losses just dealing with real estate?
Yeah, I mean, I think, that's tough. I mean, on a micro level, I'm going to keep mine focused on the insurance real estate
that's
space.
Fine.
On the real estate space, though, not being able to in affordable housing and having one of my homes in Hackla in Los Angeles, and missing the rent increase on an annual basis because I didn't get into the portal. I consider that a pretty big loss because then you got to wait a whole nother year to do it.
Yeah, if you miss that time frame, you're done.
And the requirements within those programs, whether it be San Bernardino or Los Angeles, like they're different than just the California requirements around housing. So I did not know that. So that was a aha moment for me this year. But in terms of just probably my largest loss, I like to be transparent. I think the wins are great, but I really learned the most, I think, from the losses. Mm-hmm. And that's something I know you all know you can't grow without having those losses, right?
Agreed.
You learn 10 times more from the
Absolutely.
losses than you do the wins. And
Absolutely.
in any business, you're going to have a lot of them.
Mm-hmm.
And particularly in the insurance business as you're growing and when you're younger, and when you don't necessarily fit the profile of who they see walk in the door every day, you're going to take losses because people are going to be surprised to see you there. And so I know I've had a lot of wins, but I've also had a lot of losses. And there's one in particular, with a private equity group that we worked very closely with. And it was a fresh relationship, but we were going against probably 5 or 6 different insurance brokers and based in New York. And, it takes a lot of presentation, preparation, getting the right teams internally, externally. Because at that level in this size of deals, it's really kind of it's a social game, it's a technical insurance game, it's a business game, it's a psychological game, it's an influence game, right? There's a lot of these factors that are going into it, and I just probably this year stepped in the scale where those opportunities were really presented to me, and I was getting a lot more of them, but that was probably one of the first ones, and I just remember coming down to the wire and losing. To another broker who's, arguably very good, great team, highly experienced, probably one of the really the largest in the industry and real estate, but feeling like, I showed up extremely well and our value proposition was strong. And on any given day, that would have been us that won. And so that required, 3 or 4 flights out to New York within like a month and a half span, 50, 100 hours of work put in the presentation. And, but I mean, it's, at this stage of my life, I learned a ton from it. I met some amazing people, saw how an amazing company does business. And, I'm just blessed to have the opportunity to get to the World Series, to get that final shot and maybe not get the win this year, but know that I got another 20, 30 years in this game, and that win's gonna come. It's just
definitely gonna land for sure.
Hey, it's literally right there, and now you have that experience, and now you have, obviously your presentations are all built, and you're already polished for the next deal, right?
That's what it is.
It's just a simple plug and play now.
Absolutely.
You already half of it is figuring out once you got the deck together and you got the value prop. And you have all this stuff built out. I mean, it's more plug and play.
Yeah.
Like that's huge. That's a huge part of it.
Huge, man. So yeah, man, we definitely want to, thank you for coming out. We appreciate you driving all the way up from Newport Beach, man.
Yeah, man.
Hour plus drive. But yeah, here on the Profit Zone, like I said, we talk about building wealth one property at a time. We share our wins, also our losses. We're very transparent about this. And today we're just very blessed to have Jonathon we share his experience from a risk management and also insurance standpoint on this episode. So thank you guys for tuning in, and we look forward to seeing you guys on the next episode.